Hello, fellow entrepreneurs. Mark Little here, Diversified Funding Services. And on this episode of Our Two Cents, I'm going to be talking about MCAs, merchant cash advances. My 27 years of experience in the factoring world, I've watched the inception of MCAs. I've watched the havoc that they've wreaked. But at the end of the day, I'm not going to be bashing MCAs. I'm going to be discussing the pitfalls and the fallout of not having proper decision making, and that the decisions do have consequences, and really just basically talk about the moderation of life and what applies and what doesn't apply. So sit back, take this journey with me, and take what I say. It's just my 2 cents. So go with that. All right, let's kick this off. Merchant cash advances. Decisions have consequences. This is a bold statement, but this actually podcast could save your business, and the importance of AR fundamentals and what I mean by that. We'll tie it all together for you. So I guess to start out with, what is a merchant cash advance? Merchant cash advance is the process of where a finance company will advance you funds based off your future sales. So what they'll do is ask for 3 months, 6 months, however many months, 12 months of your bank statements, and they're going to look at your average cash flow or your deposits, and they're going to advance you funds. And this is based off your future sales. So hopefully your sales stay on track and you'll maintain that consistent volume to be able to pay back the debt load of that. What I want you to do is understanding the MCAs and their risk. And I'm not saying it's completely horrible across the board, but it's the practices of it that I do have a problem with. And I think a lot of other lenders have a problem with. And I'll explain that in further detail. But the risk involved is, like I had stated, you're getting advances off future sales. So if you happen to have a shortfall, maybe you lose a customer for whatever reason, you don't maintain them sales, that advance is based off of those numbers. So you've got, you're going to be paying back whether it's a daily withdrawal from your banking account or a weekly withdrawal from your banking account. That's how MCAs are paid back. So if you have a dip in sales, that's not going to change the payback schedule. So you can see how that can quickly build up and be a very uncomfortable, difficult situation. So I'm going to address the elephant in the room: multiple MCAs. We have literally, when we had our factoring company before I sold out, back before COVID hit, we come across a company that had 8 MCAs. It was really mind boggling. 8, not just one, 8. We've seen plenty of companies that have had 2, 3, and 4. So those decisions have consequences. We came across so many businesses that made unwise choices based off whatever decision that forced them into that corner to take out the first one to begin with, and it just snowballed from there. Paying back those advances was just sucking the cash flow out of their bank accounts. And so I think what I want to argue, or the frustration about it, is the rules of engagement and exploring what other options that you have. So with that, I'm going to jump right into factoring. What is factoring? Factoring is a process of buying your accounts receivables at a discount. So this is after the product has been delivered or the service is rendered, and you invoice for that, and you wait your 30, 45, 60 days, whatever terms you agreed upon with your vendor, of paying that invoice back. So you're actually getting an advance off of your money. It's not off of a future sale. The product's been delivered, the service has been rendered. Just to give you an average of how it works, you'll get maybe an average of an 80% advance on the face value of that invoice. The factor then owns the receivable. They wait for payment to be paid from your customer. And then once that invoice is paid, you're giving that 20% minus the fee for that service. And that fee can range from a prime plus type of structure to a flat rate. Typically can average to what you'd pay with a credit card transaction, 2 or 3% on 30 days. Keeping in mind the longer the invoice is outstanding, those fees do adjust from that. That's what factoring is. You, of course, have other types of lines of credit, SBA, business loans. And obviously, what takes those into account is the assets of your company, the length of time you've been in business, your personal credit, all that goes into the pot, mixes up to see if you qualify for that. But I'm saying all that to sort of spin this into the consequences of multiple MCAs and the practice that some MCA lenders have that I do not agree with. That's my 2 cents, right? But UCC filings. A UCC filing is where a lender will put a UCC 1, and that gives them the rights to the assets listed in that UCC 1. To give you an example of a UCC, we all understand a mortgage on a house. Your mortgage lender files a UCC on your property, and they have first rights to that property. If something happens, they get to come and take and cover the expenses that they have or the exposure they have on that house. You do go to a second level of a second mortgage. That is a UCC. They take a second position to that first lender. It's common practices in the industry. The second mortgage lender understands they're taking a little bit more of a risk. That's why the rates are higher and the amount of availability of capital is lower because there's already that first mortgage. But that's the rules of engagement. Those same rules of engagement should apply in the commercial finance space. So whether you have a bank loan, line of credit, SBA loan, a factoring relationship, a factor will take the first position, a UCC 1, on those receivables. That means that through the agreement they have with you, that factor has agreed to purchase your receivables at the discount that's been provided in the agreement of the contract, and they have first rights to all of your receivables. That's their way of protecting their risk and their exposure. What's going on in the space of MCAs is, let's say an MCA lender comes along and your factoring agreement, let's say, does allow you to take on another advance. Most will not because they own your receivables. But regardless of that, MCA lender will advance those funds and maybe they'll file a lien. They'll be in second position. The problem comes in is to the hustle of this. So many of these MCA lenders will come along and they will offer an advance. And it doesn't matter if you have a UCC 1 in place. It doesn't matter that your receivables or other assets are encumbered by that UCC. They will advance you funds if you're literally willing to take it. What that does to a bank or a SBA lender or any line of credit or factoring account is they are coming in and stepping and leapfrogging over that UCC 1 that factor has in place or that other lender has in place. And they're coming in and they're grabbing that cash flow to repay that advance, whether it be daily or weekly. And of course, they're basing it off your future sales. It gets very complicated and very ugly. We have seen it come to the point, and I know if the MCA lenders out there, they don't like this either. The fact that a lot of business owners get so backed into a corner, they'll actually close out their banking account that is tied to for them to repay that advance and open a whole other checking account to get around that because they're drowning. They're actually on the verge of going out of business because they have not only taken that one cash advance, and if they are factoring or they do have other financial products in place, they are just slowly pushing themselves into a corner and have seen it far too often. The business owners are on the verge of closing their doors because they cannot keep up with the debt load of repaying these advances. I wish the practice would stop. MCAs, like I say, I'm not bashing them across the board. A lot of times companies do need a quick access to capital. Their underwriting procedures do allow them to move faster than a factor, much faster than a bank. And maybe it's a good pressure relief, a relief valve to get the capital needed for having that cash flow shortage. So there is a place for it. But it gets into life decisions in moderation. I'll give you a silly example. A liquor store is there and they don't, you know, monitor anybody. If you're someone that is okay with an occasional drink and you drink in moderation, you're going to that liquor store and they don't know how many times you drink a day or a week, and they'll sell it to you. But there's people that become addicted, horrible disease, alcoholics. That liquor store will still sell that liquor to whomever comes in to buy it. They're not monitoring what you do with it. It's the same thing with these merchant cash advances or any types of financial products. If someone will allow you to take as many as you want and they say, yeah, you qualify for it, there's enough cash flow in there, we'll advance you. We don't care that you have these other arrangements in place. We don't care how many other lending products you have before us. We don't care. Here's the terms. If you take it, pay it back. So that's what I mean by life decisions and moderations. If you are in a position as a business that you need to take out an MCA to pay another MCA to keep that MCA off your back, and then you're heading down a very vicious cycle. You're jeopardizing the relationships you have with your senior lender that's in place. And that gets into where I want to wrap up my final thoughts, and the financial decisions you make today will shape your business's future. And that's why AR fundamentals matter. And that's the foundation of financial health. So follow me with this thinking here. You're B2B, obviously. That's what we're talking about here. And you're invoicing your customers for that product that's been delivered or that service rendered. And you're going about your business. Sales are fantastic. You're growing, you're expanding, etc. If you're not properly managing your AR and they're not turning in an efficient manner, that of course is going to create a cash flow shortage, right? That's where the pressure begins. That's where businesses can drown on their own growth. The sales are fantastic. The volume is fantastic, but you're not able to keep up the pace of money going out, money coming in. So if your terms are healthy and your terms are fair, but your AR is not turning within those terms, then obviously, right, it's going to affect your cash flow. And that leads to making decisions of the right financial product. So what I suggest first is to have that fundamentals in place, have your AR turn management in place. So you have a system in place. You're staying on top of customer service calls on the, introduction of the invoice to make sure your customer is happy with the product or service and identify any issues that may need to be corrected then instead of finding out 30, 45 days later. When it's time for the invoices to pay, doing those friendly follow-up calls to make sure those invoices are slated to be paid in the agreed upon terms. That gets back into the healthy relationships, belly to belly, human to human interaction, and building those rapports and relationships. That's where I say technology is fantastic. Technology is great. You can send out the auto reminders. You can send out the emails. You can do as many things as you want for auto technology contact. But that is not enough. A lot of times it's just not enough. So having someone to focus on your AR, whether it's you hire someone internally to take care of those things or outsource something like that to Diversified Funding Services, to where we specialize in receivables. We are that extension of your company on your behalf to monitor and follow your receivables, to know where they are each and every day of the month. And to know when an invoice is due, we're going to help stay on top of that. We're going to make those customer service calls to make sure that the invoices are slated to be paid on the time that they were agreed upon. Once your AR is turning efficiently, you may not need the working capital you think you need, right? And then if you still are having growing pains, then it's time to get an interjection of capital and decide which is the best injection of that. Obviously, if you're a stable or established enough company to qualify for traditional lending, that's going to get into your tax returns, your time in history, your credit, all those things. In factoring, it's going to be most focus put on who's paying those invoices. That's where the focus is put on. It's not per se as much on you and your company, it's who's paying the invoice. Is it a credit-worthy company? It also helps you make sure you're invoicing credit-worthy companies to begin with. That way, you're getting an injection of capital when that product is delivered or the service is rendered, and then your invoices are being monitored. You're getting the invoices paid, then you're getting that rebate of the balance of it, so on and so forth. And you just go. There's no debt. Obviously, there's debt in other types of loans, SBAs, lines of credit. You borrow, and it's like, okay, now you got to pay us back. Same thing with an MCA. You get that advance, you get the capital, now you got to pay it back. And factoring invoice, you get the advance, invoice pays, you get your additional capital out of that. So in a nutshell, that's how it all works. That's my overview and view of this. That's why I suggest that you reach out if you're having a situation with your AR not turning efficiently. Reach out and let's talk. See if we can't put together a program that fits your company to help your business run more smoothly. Once we get the AR management, turn management in place, then we can assess and go, hey, I think factoring would be a good fit for you, and we can help find you that proper factor that has the right appetite for your business and can provide you the rates and the capital that you need. Maybe you want to move on to other types of finances as you mature, but let us get your AR into shape. Let us get that in order. Let's get those basic fundamentals in place. Then you can assess what to do, because I'm telling you, it's happening far too often, and it's causing a lot of heartache and stress for the business owners that just do not have those fundamentals in place. You don't have a good grasp of your cash flow. You're waiting till it's too late, and you've got something dangling in your face that says, hey, I can get you money in 24 hours. You take it. And the next thing you know, you're chasing your tail because, man, I didn't realize that paying this back was going to take such a toll. And then you're in a pickle, right? Then what do? Well, unfortunately, it becomes addictive, and you've got a second one, then you got a third one. It's just, you see where that story's going. So anyway, let's talk. Give me a call. Go to the website, fill out a contact form. Let's have a confidential consultation and see if we cannot come in, serve your company, be your back office support for AR turn management. We'd be proud to serve your company, and we look forward to hearing from you. Any questions, comments, reach out. Let me know what you think. But I'm Mark Little. That's my 2 cents. And until next time, we'll see you on the next episode.